What's going on, everybody? Welcome back to my YouTube channel. Now, today I'm going to be breaking down four powerful entry techniques rooted in my two candle theory concept, which is a simple, no nonsense approach to trading that's based purely on market movements. Now, today I'm going to walk you through the behavior behind each technique. I'm going to explain the why and show you how to apply them effectively in your trading. Now, if you're new to my channel, welcome. My name is Tony, also otherwise known as Rocks, and I created the two candle theory concept, the most straightforward trading theory out there. No jargon, no fancy acronyms, just real strategies that work. And if you're ready to dive in, my full 5-part series on the two candle theory concept is live on this channel. So feel free to check that out when you're done with this video. Let's get straight into it. The first entry technique we're going to be looking at today, guys, is the exhaustion reversal. Now, why does this work? Well, the first step of this entry technique is this, the extended push, right? The setup begins with a strong directional move, which is characterized by at least three or more large ranging expanding candles in the same direction. So often it's going to be bearish or bullish. Now, this phase signals that the market is trending aggressively, often overextending itself. Why does this matter? Well, large candles indicate institutional involvement or, let's say, strong momentum. However, no market trends last forever, right? So this phase sets the stage for what we call an exhaustion. And that moves us on to the second stage, which is the pause or the indecision phase, right? Following the extended push, the market slows down with a candle in the same direction as the prior trend. However, this candle typically has reduced range or forms as an indecision candle. You might know it as a spring in top or small body. And then this pause reflects hesitation among market participants. Now, why does this matter? Well, the shift shows the trend may be running out of steam. So sellers in a bearish push, in this example, are losing strength. And buyers are starting to show interest, leading to a potential reversal. And then we have the third stage, which is a rejection candle, which is the opposing force, right? An opposite colored candle then forms, bullish or bearish, or vice versa, doesn't matter. And this candle is critical when it comes to this pattern because it has a range, but it fails to break the prior low or high, which is signaling the rejection of further momentum in the original direction. Now, again, why does this matter? Well, the candle represents a shift in control and the inability to break lower or higher after such an aggressive move confirms that the market is preparing for a reversal. And then we have the final phase, which is a confirmation, which is a continuation entry. So after the rejection candle closes, the next candle opens and begins moving in the direction of the reversal, which is bullish in this case. And then the confirmation candle provides an opportunity for a continuation entry off of that level as buyers take over following the extended bearish push phase. Now, again, why does this matter? Well, waiting for the rejection candle and entering on the confirmation reduces risk by aligning with the reversal momentum, ensuring that you don't get caught in premature entry. All right, let's take a look at the exhaustion reversal in this example here on EURUSD. Now we can see here we have a bearish candle close based on the two candle theory. We anticipate the next candle to obviously go bearish. And as you would, we will not stop anticipating this to continue bearish until price gives us a sign. Now, per the exhaustion phase reversal concept, what we're looking for here is for price to show strong signs of a bearish momentum, as you can see in this instance. Long story short, we're looking for the indecision, which is a slowdown in that bearish behavior to the downside. And then we have a candle closes in the opposite direction as to the direction that the market is going, potentially indicating a reversal after this exhaustion. So we have strong momentum, a depletion, a potential reversal, bulls taken over. And then what we're anticipating here, as per the two candle theory, is for price to continue to push bullish. In this instance, this is what we see. And what we're looking for here when we're taking this trade is looking for price to create, as we know, the anatomy of a candle formation, which is let's just say a wick first, not let's just say it is a wick first and then body next. And then we're looking to take this for a positive risk reward ratio. This is not what this lesson is about today, but let's just say we're going for a 1 to 2. We have the pattern, We have the behavior, we have the principles, we have the entry, and then we're looking for a continuation with positive risk to reward, which is this trade here. Okay, so this is an example of the exhaustion reversal, as you can see, and this is how it pans out. Let's move on to pattern number two. So pattern number two is the rejection snapback. And what this emphasizes on, guys, is the market's false breakout and subsequent shift back into the previous range, followed by a bearish or bullish continuation. Now, why do we call it the rejection snapback? Well, the rejection firstly highlights the initial rejection of bearish momentum during the pause phase, the bearish candle with the large wick, obviously. And then we have the snapback, which captures the immediate reversal after the bullish breakout, where price snaps back into the range, signaling a failed breakout and a shift to bearish momentum. Now, how does this kind of work? Well, firstly, bullish momentum phase. The market is in a bullish trend with a strong momentum. It could be bearish as well, but in this example, a bullish trend with a strong momentum. A candle then closes strong, showing buyers are in control. Then we have a pause phase, right? So this is where a candle forms, attempting to push lower, but closes with a large wick rejection, which is signaling that bullish pressure still dominates. And this serves as what we call a pause and not yet so much a reversal. And then we have the breakout phase. So that's a strong bullish candle which follows breaking the high of the previous two candles and closing firmly. And then this really appears as a continuation of the bullish trend, luring in what we call breakout traders. And then we have the snapback pause, right? Which is immediately after the breakout, the price snaps back into the prior range with a bearish candle closing back below the breakout level. And what this really signals is a failure of the bullish continuation and a shift in momentum. So then we get the two candle theory sell opportunity. A bearish candle forms, providing a clear entry point for a sell as the market confirms bearish momentum of that failed breakout. Now, why does this work? Well, psychological trap, maybe, right? The false breakout traps buyers expecting a continuation, creating an opportunity for sellers to take control. Momentum shift, right? The rejection wick in the pause phase combined with the snapback illustrates the loss of bullish strength and the emergence of bearish momentum. And then we get clear structure, right? Each phase of this setup provides clarity from the bullish build up to the reversal and confirmation. So this is a great pattern. And if we look at pound USD as an example here, you can see this bullish momentum. We've got a nice higher low, really strong bullish candle. And if we look at the formation of this market, price has been failing to break above. We finally get that pullback higher low, break above. And then immediately after that, look what we get. Price attempting to go bearish in amongst this wick rejection zone, but we don't necessarily close bearish. We still have that bullish sentiment, and we still, can see that there is a lot of buyers or buying pressure in the market. And then all of a sudden, what do we have? A breakout. Now, obviously, with this extended market, which we just looked at our previous example of first entry technique, we have a really extended market. You can see that price has pushed for long periods of time without a pullback. And at this moment in time, we would expect a continuation. We can't think of anything else. This is the two candle theory at the end of the day. We're looking for buys. Let's say we take the buys and we lose, whatever. But look what happens next. Price snaps back into this area where it broke out of. Strong bearish momentum candle indicating that depletion in that bullish sentiment and that immediate selling pressure into the market. I mean, as I always say, if you had a gun to your head, not literally, but you know what I mean, what do we expect the next candle to be? Bearish. So let's say we take this trade. I'm not doing scaling down techniques. You can go back and watch the series, but let's just say we go back, place a stop loss around the 50% retracement range just to make sure that we've got a nice safe stop loss here, and we take the trade based on this snapback. We go for a 1 to 2 risk reward ratio trade. Bam. There we have it, guys. A really nice rejection snapback. Bullish momentum in the market. Look like we're reversing at the reversal zone. We have a breakout, an immediate snapback into this zone, and then we expect what? Nothing but a bearish sentiment reversal at this stage. So that's pattern number two. Now let's look at pattern number three, what I like to call the momentum builder. Now, why do I call it the momentum builder? Well, momentum obviously reflects the gradual buildup of pressures the market consolidates with indecision candles. Okay. And then the builder part highlights the steady preparation for the breakout, signaling that bullish or bearish momentum is ready to kind of resume with or as a reversal without the continued market direction or previous market direction. Now, how does this work? Well, firstly, we have that bullish structure foundation. So the market is in a clear bullish trend, as we can see from this example, which is establishing, higher highs and higher lows. Buyers are in control, so we can see that. But momentum starts to slow down as price enters into a consolidation phase. So we're not breaking the highs, we're not breaking the lows. Then we have the second part of this phase, which is the indecision phase, which is a series of 3 to 5 candles with wicks on both sides, right? That starts to form, which represents indecision, obviously. Now, these candles fail to break any significant higher lows, which is signaling a temporary, let's say, equilibrium between buyers and sellers. Firstly, why this matters, because this phase reflects the market loading up, as it were, for its next kind of move, with traders waiting for confirmation of direction. Then we move on to the third stage, which is what we call the breakout candle. Now, this is, in this instance or example, is a bullish candle breaking above the high of the indecision range, which is signaling the return of a bullish momentum. Now, this candle is strong with minimal wicks to the downside, showing clear dominance by buyers. And then we have the two candle theory concept. So after the breakout, the market follows with your two candle theory confirmation, ensuring that the breakout is validated. And then this step filters out false breakouts, obviously, and then kind of sets up the confirmation phase. And then obviously we have the bullish continuation, which is the next phase in this pattern, which is a continuation of the bullish trend, which offers a much higher probability entry point as momentum builds further. So if we take a look at this example on USD CAD here, you can see that we have market conditions here. Price is failing to break the structural lows. We're at some all-time lows here. We've had price going bearish. We've got this lower lows and lower highs. Then we have this very strong momentum to the upside. Now, we've not necessarily built much structure here at this moment in time, but it's important to recognize that if we're failing to break these structural lows, we're failing to break these structural highs, what we're looking for here is that momentum build up. So we're looking for price. This example is going to be bullish, but we're looking for price to break the highs or the lows to indicate a bullish shift in this pattern here, which is showing a depletion in either or direction. So like I said, we don't know if there's buyers or sellers in this market at the moment in time, but what we're looking for here is for these wicks to then finally show us that we've broken out. What you want is something convincing, guys, something real convincing, not just a little breakout, something convincing, where we don't have the wicks at the top, we don't have the wicks at the bottom, and we have a directional bias. Because again, if we go back to the two candle theory concept, we just want to make a simple decision. Is the next candle going bullish or is the next candle going bearish? And in this instance, we would expect the market to continue to go bullish, as you can see here. Now, however you enter this trade, again, I'm not talking about entries, but let's just say we place our stop loss below the wick after it was formed, blah, 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 and then we go for a 1 to 2 as we have in all examples. This is what it will look like. Now, you must understand we're looking for principles here, not so much perfection, just principles, and then we're looking for our entry points. Okay, let's move on to our fourth and final entry technique. So here we have what we call the overextended reversal. Now, why overextended? Well, this clearly highlights the key setup condition where the market has gone beyond its typical range, signaling exhaustion. Then we have the reversal, which captures the shift in direction as buyers take control after the extreme bearish momentum. How does this flow? Well, firstly, the bearish overextended phase. The market trends heavily downward with multiple large, strong range bearish candles. Okay, so this is exceeding the expected range for the day or period. Now, every day has an average true range. So if you go to the daily time frame, weekly, monthly, hourly, it doesn't matter, you will see that most of the time there is an average range. Now, this signals, obviously, at this stage, in this example, aggressive selling, often fueled by panic or overreaction. Now, why does this matter? Well, markets don't move in one direction indefinitely, as we all know. Overextended creates, or overextension, should I say, creates opportunities for reversals as sellers run out of steam and buyers step in. So this moves us on to the second phase here, the rejection candle. Now, a strong bullish candle forms, signaling that buyers are stepping in after the extended bearish move. And then this candle closes with, I like to call authority, rejecting further downside momentum. Now, why does this matter? Well, this is the first step or sign to this ever potential reversal. And it shows that sellers are losing control and buyers are starting to dominate. And this is where the two candle theory confirmation comes in. Following that rejection candle, the two candle theory concept, which we're looking for here in this instance, which is a bullish candle, confirms that shift in momentum. And then this candle provides the entry signal point, ensuring that we're aligned with the developing bullish trend. And then obviously we have the final stage, which is the continuation phase. After the two candle theory confirmation, the market then continues to push higher, reversing the prior bearish trend. And this is where the profit potential lies, okay, as the reversal gains momentum. So let's take a look at the overextended reversal here. We have price breaking out of this consolidation to the downside. Are we selling or are we buying, guys? We are selling. We have a very overextended market here. As you can see, the range of this candle exceeds the previous range of all the other candles in recent. It's absolutely huge. At some point in time, the market is going to have to correct itself. And as you can see here, we have a correction in the market. What are we expecting? We have a massive push phase. We can look for at least a 50% retracement of that daily candle, 4H range, whatever it may be. And then we can look for a buy. It's part of the two candle theory, is it not? Right? After this candle closes bullish, what are we expecting this candle to do? Close bullish. Just like when this closed bearish, we expect the next candle to close bearish. We expect this to go bullish. So what do? Wait for our entry. How are we entering this? Well, go back to the series. There's a 5-part series, guys. You can take a look at that for yourself. But we'll do a 25% retracement stop loss here. Keep it nice and safe. And then we'll go for a 1 to 2. Absolutely gorgeous. Very simple. And guys, all I'm sharing with you now is 4 simple entry techniques that you could use with the two candle theory. Here they are once again. We have the exhaustion reversal, the rejection snapback, the momentum builder, and the overextended reversal. Guys, I hope you found this useful because I did. It's such a great reminder how simple this two candle theory concept can be. Remember, this is understanding the principles, not so much patterns, not so much perfection in candle development. This is about principles. And if you can understand the principles that I've highlighted on this session, guys, it's going to be a game changer for you. Anyway, I hope you enjoyed this video. And if you did, I'll see you on the next one. Continue to trust the process.